Have you ever wondered how Canadian real estate investment trusts, or REITs, are faring in today's volatile market? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In a recent article by Steve McLean from Real Estate News Exchange, the past year for Canadian REITs has been marked by fluctuations and significant deals. During the closing roundtable session of RealREIT at the Metro Toronto Convention Centre, industry leaders shared diverse opinions on the state of REITs. Kelly Hanczyk, CEO of Nexus Industrial REIT, expressed concerns about the public market REIT space, describing it as broken. Hanczyk highlighted that their stock is trading at $7.60, while the net asset value is $13.17. He anticipates a shrinking REIT space due to private equity investors eyeing discounted values, although he noted that Nexus has two major shareholders unlikely to sell. Conversely, Jonathan Gitlin, president and CEO of RioCan, expressed his love for the REIT model despite facing similar challenges. Gitlin emphasized the stable cash flows REITs provide, which are attractive to investors unable to enter the commercial real estate market otherwise. He remains optimistic that the public market will eventually recognize the intrinsic value of REITs, which he believes are irreplaceable assets in a stable country like Canada. David Holden, Managing Director and Co-Head of Canadian Real Estate Investment Banking for RBC Capital Markets Real Estate Group, provided an overview of the Canadian REIT market. He noted that while the sector has recovered somewhat from its 2023 lows, it still trades at a 14% discount to net asset value. This is a significant departure from the long-term average discount of 2%. The sector's market cap decreased by $3 billion over the past year, and REITs bought back over $1 billion worth of units in the same period. Despite these challenges, 36 Canadian REITs delivered positive total returns over the past year, and the TSX REIT Index provided a 3% return. Holden also highlighted that operating performance remains healthy, with declining leverage and robust liquidity. The Canadian bond market's positive outlook on REITs suggests potential for higher trading values as capital returns to the sector. He ended on a hopeful note, pointing out that the TSX REIT Index has delivered a compounded average return of 9.4%, outperforming the TSX Index's 7%. In terms of market activity, Go Residential entered the Canadian REIT market this year with a significant initial public offering of $410 million on the Toronto Stock Exchange. Meanwhile, Canada saw the exit of three REITs, with notable transactions including Melcor Developments Inc.'s acquisition of its remaining equity interest in Melcor REIT Limited Partnership and deals involving InterRent and Dream Residential REIT with significant premiums. In a notable transaction in the Seattle real estate market, a South Lake Union apartment building has been sold in what is considered one of the highest priced sales per unit in the city this year. This information was reported by Shauna De La Rosa of the Puget Sound Business Journal. The building, which consists of 211 residential units, also includes a 14,000 square foot, two-story commercial space that is currently leased by Glazer's Camera. The sale underscores the continued demand for prime real estate in Seattle's bustling neighborhoods, particularly in areas like South Lake Union that are known for their vibrant communities and strong economic activity. CBRE, a global commercial real estate services company, highlighted this transaction as a significant one for the Seattle area, emphasizing the high per-unit price achieved in the sale. This reflects a broader trend in urban centers where demand for multifamily properties remains robust despite economic uncertainties. While this transaction took place in Seattle, it's a reminder of the potential opportunities and challenges facing investors in urban multifamily markets across North America, including Canada. The resilience of these markets, even during volatile times, offers a silver lining for investors looking to capitalize on long-term growth and stability. In a recent development in the Greater Toronto Area's commercial real estate sector, Ravelin Properties, formerly known as Slate Office Real Estate Investment Trust, has acquired the remaining 25% interest in two office buildings. These properties, Commerce West in Etobicoke and Gateway Center in Mississauga now bring Ravelin's total ownership of their GTA portfolio to 100%. This move allows Ravelin to have complete control over decision-making, budgeting, leasing, and capital investment plans for these assets, according to Shant Palladian, CEO of Ravelin. The timing of this acquisition is favorable, as leasing activity in the Greater Toronto Area is gaining momentum. The properties encompass a combined gross leasable area of 659,713 square feet. This strategic move aligns with Ravelin's efforts to stabilize its portfolio amidst challenging market conditions. In 2019, Slate had sold a 25% interest in these buildings to entities controlled by New York-based Wafra Incorporated for $131.8 million Canadian dollars. This reacquisition marks a significant step for Ravelin as it navigates the complexities of the current real estate market. Additionally, Ravelin is addressing financial challenges with a loan default on a Chicago office property. The company is actively negotiating a restructuring of an $84 million loan with CIBC. The loan is related to a 658,784 square foot building in downtown Chicago, purchased in 2019. Ravelin is working towards a mutually acceptable resolution to stabilize its financial standing. Earlier this year, Ravelin faced significant debt issues, with G2S2 Capital acquiring almost $600 million of Ravelin's debt. The company received a 6-month forbearance from G2S2 to negotiate a recapitalization plan. This move was part of a broader strategy to address Ravelin's debt load, which had been a source of internal and external challenges. Despite these hurdles, Ravelin's portfolio remains extensive, with approximately 6.3 million square feet of office space and an additional 191,401 square feet of non-office space across Canada, the United States, and Ireland. As the company works through its financial and operational challenges, the strategic acquisition in the GTA highlights their focus on long-term growth and stability in key markets. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.